Thanks very much for all of you coming to listen to us. So I'm Dan Coatsworth. I'm the editor of Shares magazine. I'm really pleased today to welcome three very knowledgeable people about the stock market, and they can tell you lots of useful things to help you become a better investor. So on my right, I have Ed Page Croft, who's the Chief Executive of Stockopedia. I have Ed Bowsher, Senior Analyst at Share Radio, and Simon Lambert, the editor of This Is Money. So really, the way we'll work today is we'll give a quick discussion about investing in the stock market for income, but really we want to hear your questions and see how we can help you. So please think of questions. I'll open up the floor pretty soon. We've got 40 minutes, so hopefully we've got plenty of time for everyone who wants to ask something. So really, I guess as an investor, particularly if you're new to this, you think, great, I want to invest in the stock market. I'd love some dividends. Where do I find which stocks to buy? I mean, should we start with Ed? Where is the first place people perhaps should go?
Well, I think the first question people need to answer is how they want to go about finding income. You know, I obviously am very biased towards stocks, investing directly in stocks, and because you cut out the extra layer of fees that you might get from a fund manager, but people do need to ask, do they want to actually have the hassle of investing and building an income portfolio by themselves? So one of the key questions to answer is, should I buy it in an ETF, or buy a fund run by an expensive fund manager, or do it DIY? I will always say DIY. You guys might disagree with me, but because there is a simple mathematics there that you can cut out a lot of that costs. And also, by investing directly in stocks, you can invest in much sort of higher probability shares. You might get more capital return too. So that's what I would say. Over to you.
I think it's horses for courses. I think for some people, funds are a great option. Shares, well, if you're looking specifically for shares, one great way to find them is to go to the websites of some of the top income fund managers. Neil Woodford, very successful. He runs the Woodford Income Fund. Go to the Woodford Income website and have a look at some of the stocks that are in his fund. That's a great way to start looking for individual stocks. I mean, I can say more later about how to pick individual stocks, but for many people, funds make more sense. You don't want to pick your own portfolio, and there's some great income funds out there. I could go through a raft of them, and I think for income, I'm happy to pay a fee for a manager, because it's not just about picking the stocks with the highest yield. It's about picking stocks with a high yield, but with a yield that is probably going to stay high. In other words, the company isn't going to get into trouble and have to cut its dividend later on.
I mean, one of the other places I would think about looking would be to investment trusts. And I understand what Ed says about the DIY element and about why pay some bloke some money to do this for you. And I think some of it is about actually avoiding making mistakes. Now, if you use Stockopedia, which is actually a great website, you are going to minimize your chance of making mistakes. And I'm genuinely saying that's true. But a lot of people just look at stuff and go, oh, a bit of that, a bit of that, a bit of that. And a fund manager will basically be looking at those shares and doing things. But I would say investment trusts are a good option because the manager basically has the ability to hold some money over in the good times to continue paying that dividend in the bad times. And that is why you get these things called the dividend heroes, which the AIC, the Association of Investment Companies, publishes, which is a list of investment trusts that have been raising their dividend every single year for an incredibly long time. And you can pretty much guarantee that if someone's been raising their dividend every year for the last 30 years, they're probably not going to want to cut it next year and ruin that record. The other thing is that the managers aren't forced to sell. As in an investment fund, if people take their money out, then they've got to hand them their cash. With a trust, it's closed-ended, so there's a share price and there's a net asset value. So I think investment trusts are also a good option.
So I guess when you're looking for on the fund side, which includes investment trusts, it's important to look at the description of the product that might interest you, because some might say Inc, some might say AC. Now these are two very important things. Effectively, one means give you cash in the pocket, the other means it's going to reinvest it. But I mean, I don't know if anyone sort of on the panel wants to sort of comment about that further, or this is just simple about sort of understand. Or
I suppose you need to think about what you're investing for income for. So are you investing for income because you actually want to draw an income, or are you investing for income because you think that the long-term power of compounding dividends is a great way to make money? which it is and has been shown. And so if you want to actually take the money from that fund, then the INC version, the income version, is what you need. If you want to roll those dividends up, so those dividends are being reinvested for you, then choose the AC, the accumulation version, and that's just rolling up. And that's somewhere where funds do become very useful, because with an investment trust, you have to reinvest your own income, and the same is true of shares.
And of course, the beauty with the funds and the income and accumulation, if you say, I'm 47, so I could take income now, stay invested in the fund for the long term, and then say if I retire at 60, switch over to accumulation, which is easy to do. Switch from accumulation now to income when I'm 60 and start taking the income when I need it.
Yeah. Okay. So if you if you're looking for income stocks, is there a rough figure, percentage-wise, that people could expect now? Because if you went to your bank account, your local bank or building society, they would struggle to offer you 1% interest. I mean, where do we stand now with stock market?
Well, I think, statistically, I should have looked this morning, but I think the median yield on stock, on dividend-paying stocks, is around the 3% mark. It was a tad below, and in the recent correction it might have gone a tad above. But that's the median, right bang in the middle of all dividend payers. But of course, you can be much craftier and find very, very good quality sort of dividend yielding stocks that actually, in an entire portfolio, can yield you about 4.5%. And this is where you start going to the world of quality, what we call quality income, which some have sort of said is a sort of separate asset class. But I think on that point of reinvesting dividends that you're talking about, that does need to be, that point needs to be sort of driven home. If people do not need the income, keep reinvesting it in the best dividend payers, because that power of compounding, we all drill it home all the time, but everyone forgets it. And that is how to turn, £100 into £1 million. But in terms of the actual numbers back to the numbers on yields, I mean, I've got a list here of shares that I've taken from our website, which I should have done an average of this, but they're all, these are taking a set of stocks above an average yield in the market and above 100 million market cap. So, these are sizable companies, and then looking at and then sorting it by what we call our stock rank, which looks at lots of different quality factors. And you can see that the average yield on this list is probably around that 4.5% mark. So I think you can build a very, very good portfolio at around the 4.5% mark. And obviously you have equity risk, but I think that is the kind of yield that quality income has been giving lately.
Yeah. I think obviously when you think of a company, if it can actually afford to pay a dividend, would you say that's actually a mark of a quality business because it has money that's excess to its needs? Or do we also have to check, is it reinvesting any money in the business? Because if it's not, then perhaps the business is not sustainable.
There's an interesting cultural thing there, because I think traditionally many American investors see a dividend as a bad sign because they think, well, the business is slowing down. They've got nothing that they can invest in. There's no growth to come. Many British investors are happier to get that dividend, and I certainly think a dividend is great news. It shows the company is profitable. It shows the management is confident about its future. And as long as that dividend is well covered, in other words, the profits are substantially higher than the dividend, that's a very good reason to buy a share. And over the long term, research suggests that if you're a really long-term stock market investor, about 2/3 of the total return comes from the dividends and hanging on to those dividends and reinvesting them, and 1/3 comes from that capital appreciation, in other words, the rising share price, assuming the share price does rise.
And of course, the other thing that should be remembered is that a lot of companies prefer to do buybacks. So you can return capital to investors a couple of ways. One way is by paying a dividend. The other way is by the company buying its own shares. Literally, the company will eat itself. But what the problem with buybacks is a lot of company management will use it as a way to massively inflate earnings per share and then give themselves huge bonuses. So actually there's less discipline there. One of the great things about a yield, a proper dividend, is it imposes a kind of capital discipline on the management team. When you've got a clientele of investors who expect dividends, if you cut your dividend, your stock will get absolutely hammered. And that clientele of investors expects that income. So the management will know that, feel forced to keep paying that dividend, and therefore they'll impose more conservative policies in their investing and so on. And actually that's one of the reasons that dividend-paying stocks do tend to outperform on a total return basis.
And it doesn't actually, the other thing to say is it doesn't have to be a big dividend. It doesn't have to be a 4% dividend. It could be a 2% dividend. There are plenty of companies out there that are still growing and they feel that they can deploy their cash better, but they want to reward their shareholders, and they will perhaps pay them a 1.5% or 2% dividend. And even though that doesn't sound like very much, over the years, that effect of compounding, especially if they can keep growing that dividend every year, really does pay off. There is one very famous investor, though, who doesn't pay a dividend, doesn't agree with his company paying dividends. You know who that is? It's Warren Buffett. Berkshire Hathaway does not pay a dividend. And every year, there's always a little bit of pressure to try and get him to pay a dividend. And he saw that pressure off last year. And he wrote about how basically he thought that he could deploy that money better within his business. What's interesting, though, is that he likes buying businesses that do pay a dividend.
Yeah. So if I was an inexperienced investor and I go to one of the many financial websites that that can screen the market for you. You can type in, I want to see a dividend yield, say 4% or more. You might be given a list that starts off with lots of at 4%, 3%, even if you want that low, but also have some at 8%. Do you think naturally people would jump to the 8%? That's a rare opportunity, I must have it. Is that, and clearly there is a danger, isn't
The dividend trap.
Yeah. Generally, these highest yielding shares, it's often a sign that there's going to be a dividend cut. So, if you find a big blue chip which is on a 9% yield, be highly skeptical. And one of the reasons to look for quality, when we'll talk about quality measures, I'm sure shortly. But actually, if you go and look at the very, very top set of dividend yielding stocks, and we've done analyses on these, they often underperform the ones which yield less, because those yields on average will be cut or won't become realised. So remember, a lot of data is backwards looking, and often if there is going to be a cut, the brokers have not factored it into their forecasts. So the very highest yields you've got to be a little bit careful with.
Just one other point on that. I think sometimes when you look at the highest yielders, just looking at the FTSE 100, say, and the high yielders, and they're often many of them in the same sector. This happened in the run-up to the financial crash, when a lot of the highest FTSE 100 yielders were banks. So you might have just gone and looked at the list, bought 5 banks, put all your money into banks, and then the share price crashed. So it's very important, if you want to reduce the risk, to spread across the sectors, even if all the shares are fairly high yield.
The same thing happened recently with the supermarkets as well. Tesco, Sainsbury's, Morrison's were all yielding very, very big amounts, and we know what happened next. They cut the dividends.
Yeah, I would say before the financial crisis, Lloyd's banking group, what was it? It was about 8% yield. Just as a quick show of hands, has anyone owned shares in Lloyd's that had it before the financial crisis and still has it now? Anyone stick their hands up? Yeah, I expected quite a lot of people.
I've got from Halifax's demutualisation all those years back. So I had some money in an account and I held those shares. They went all the way up to £10 and then they went all the way back down.
So I mean, just anecdotes. I've talked to people and they all say, I'm sticking with Lloyd's. It paid 8% once. It's going to pay it again. I mean, it's a good example of you cannot expect companies to guarantee you to pay dividends every year, and you also can't expect companies who's got very, very strong brands to still be able to pay dividends, because things can go wrong.
I'll give you another very, very good example of that, and another example of something that I did own. HMV, basically. HMV at one point was yielding 10%, basically. And if you looked at HMV at the time, you thought, there's no way that this business can actually fail, because it was the only music shop left on the high street. Yes, people are moving to buying music online. Yes, there's the whole change to MP3 and everything like that. But, our price was long gone, Virgin was gone, Woolworths was gone. How on earth was HMV going to fail? Well, basically, it wasted a load of money on buying this live music business, and it had a lot of debt. The dividend was cut, the company went bust.
Yeah, so it's good to remember, dividend is paid out of cash. If the company has no cash or needs the cash to pay its the borrowings, then it's not going to pay it. So, I mean, how can we tell as investors if a company has enough cash? Is there a metric or a test that we can use?
Well, a very famous one that most people use is the dividend cover, which essentially compares the company's earnings per share against the dividend per share and shows you how many times the dividend is covered by earnings. Some people prefer a cash dividend cover, which shows that the cash per share against the earnings, but the earnings is pretty good. And a lot of people have a rule of thumb of about sort of 1.5 times earnings, then you'll feel a little bit safer. When companies get much lower, obviously, you've got to sort of think, can they weather a storm enough? So what a lot of companies will do is, if they don't have enough earnings, they'll use their cash on hand, and which is fine as long as they've got enough cash to keep paying that dividend. But when it gets really bad is when a company starts issuing debt to pay dividends. Now that's madness, and lots of executives do that, so don't ask me why. But it's a bit like feeding a cow its own milk.
Yeah. I mean, what did Apple do? To pay their dividends? Because they have loads of cash, but
they've got a phenomenal amount of cash, don't they? But they basically can't bring the cash back into the States, I think. So they've got a lot, and they actually, they issued bonds, didn't they, to pay this dividend. But then Apple is kind of maybe a special situation in that it does literally have this absolutely massive cash pile and these big earnings. The thing I'd always watch out for with an income share is cash flow as well. Sort of as Ed was talking about there is, look at the cash don't just look at the profits that business has got. Look at what it's got left after it's had to pay out all the other things it's got to pay. Its interest, charges, its tax bill, and everything else. Is it covering that dividend out of cash? And if it isn't covering that dividend with cash flow, then that's a big red flag.
And I'd look at the balance sheet too. If there's not too much debt, then it'll be easier for the company not to cut the dividend if things do get a little bit tough.
Yeah, and there's a lot of other metrics that people do like to look at. You mentioned dividend heroes, you called it. In America, they call it dividend achievers or dividend aristocrats. Those companies that have a hugely long history of never cutting dividends. And we recently did an analysis on the companies that haven't cut their dividend in the last 10 years and have grown their dividend for at least 7 of them. And the returns were quite something. We ended up with we had a few different filters. We ended up with a list of 33 stocks. And if we took just the highest yielding 20 from that sort of, I think it was 30 or 40 stocks, it returned about 12% total return the last year, which is pretty good. But actually, if you didn't just reach for yield and look for the highest yielders, you ended up with a much, much bigger total return. If you looked actually for for example, the lowest volatility, or looking at almost any other way of sorting, looking at the cheapest ones on the PE ratio, you ended up with about a 20% return. So, again, that's sort of an example of why sometimes only naively looking at the yield can be a little bit narrow-minded. So, think about total returns, not just yield, in my opinion.
And that yield as well, the yield that you get is the yield based on the price of the share when you buy it. So, that's what it would pay, the dividend it would pay you at that price you buy today. If you buy one of those companies or one of those investment trusts that does build up its dividend every year and pays out a little bit more every year, and if you never buy any more, you've just got your original holding, and the share price rises, well, A, you're going to get that growth from the share price because people are going to be attracted to this rising dividend. But B, the actual yield compared to what you paid for that share is just going to keep going up and up and up and up every year. And in 10 years' time, you might have bought it. When you bought it, it was yielding 2%. But it will be yielding an awful lot more than that if it raises its dividend every year for 10 years.
Yeah. Okay. So hopefully that gives you a flavour for, it's like a quick start to understanding it. But so I open up the floor now to some questions and see if we can help answer what's going on. So, sorry, the light is shining bright in my eyes. So there's a gentleman down here. We'll wait for the microphone to come round, and I'll make sure we go around the room. So,
as we move back into a normality of banks, central banks raising rates, especially in the Western world, how will that affect your strategy? Will it make a difference to what you would classify as income shares and income selection?
And it may mean the differential between interest rates and dividends does contract somewhat, yes. But we'll have to see. You could also say that interest rates will only rise if the economy continues to recover, so actually businesses will be able to increase their dividends in line as the interest rates rise. So it may not make as much difference as you might think.
And companies know as well that they've got to pay a dividend that's attractive versus cash. They know what you can earn from your savings in the bank, so they will be trying to. You would expect to see some form of rise in the yield on shares because they're competing with that return on cash. But the thing to remember about interest rates is that they're forecast to rise maybe early 2016, but the general forecast, and bear in mind these things are wrong all the time, is that they will rise very, very slowly and very, very gradually. Basically, the UK economy, the US economy, the Western economies cannot handle interest rates going up very, very quickly. So barring some form of major inflation shock, I genuinely could not see a scenario where they do. And if you look, the Bank of England every 3 months puts out its quarterly inflation report, and it puts out a chart and a table where it keeps saying to everyone, we're not going to raise them very much, we're not going to raise them very fast, we're not going to raise them very much, we're not going to raise them very fast. I'd be very surprised if that wasn't the case.
I think also for investors that are, we've had a 6-year bull market. Everyone's feeling a little bit flighty. You know, I've noticed it over the summer that, you know, you kind of see less interest. People have been a little bit sort of scared by the 24th of August, you know, fall. It's natural that we have a correction year. Are we going to see bear market? Who knows? Who knows? But one thing I can tell you is that in bear markets, dividend-paying stocks are the best part of the market to be in. If you actually looked at the quality income part of the market, segment of the market, it tripled in value between 2000 at the top of you know, the dot-com bubble to about the last time I looked, which was 2013. That segment of stocks tripled in value, and these are dividend-paying stocks. I think I have a statistic actually, because we wrote an ebook on it, and we did tons of research into the literature. In bear markets, dividends, the amount of equity return that comes from dividends becomes 90% of the return in bear markets. And also, dividend-paying stocks fall by far less. Dividend-paying stocks tend to be lower volatility, so what happens is that when the market falls, they don't tend to fall as much as a set. So people having a dividend income strategy in the market should feel more secure than the majority of equity investors if they are worried about, you know, rising inflation rates, possibility of bear markets.
But it's also true to say, if we did go into a bear market, when we're then coming out of that bear market, dividend stocks aren't necessarily the best place to be. That's a mistake I made coming out of the financial crisis when I thought, right, everything's too cheap, I'll buy now. I bought too much quality, and the best place at that moment was trash, as it was called at the time. It was when the dash for trash, so I got that one wrong. So there is an element of timing here as well.
So in the next financial crisis, you're going to do just dandy.
Exactly.
Yeah. Okay, so next question, please. Right at the back of the room there.
Just got a quick question on dividends. When you reinvest in dividends, would you take the dividend as cash and then reinvest in a separate stock, or actually reinvest the dividends in the same stock, which I find you'd be paying at a higher share price than you initially bought at? So I don't know which option's better.
Well, there's a cost element here. So basically, reinvesting dividends from shares costs money. And depending on what platform you use, that price will vary. So some platforms will allow you to do it at a relatively small percentage cost of the dividend. Some will charge you, say, £1.50 if you sign up to a regular dividend reinvestment plan. Some don't do that at all, and you'll just have to pay the standard share dealing charges. Clearly, if you're getting paid a dividend of £20 and it's going to cost you £10 to reinvest it, then that's not particularly cost efficient. So an idea is to bundle up those dividends together until you feel you've got enough to invest, and then invest that into one stock. Now, which stock you invest that into in your portfolio is then the next issue.
Yeah, you have to keep thinking about what's the best opportunity set available. You might find that actually the good high-yielding stock that you previously bought is not right at the top of your list anymore, and you should keep very good advice to just minimize the cost. You know, dividends, as you said, very, very small, and you don't want to be paying that brokerage fee every time that you reinvest it. So very good advice to keep accumulating. But yeah, I would personally always invest in the best opportunities available, not necessarily the same stock. Although you guys might have a bit more information on this. I think some bigger companies actually, they do reinvestment plans themselves. Do you know how cost effective it is?
They do, but the problem is you then need to be holding those shares directly with the company, normally through their registrar, rather than on a platform, which everybody likes to invest on, a DIY investing platform nowadays where they can see everything in one place.
But of course, the other thing here, if you really do want to reinvest in the same investment As we said at the beginning, that's the argument for using funds, get the accumulation units, and that's easy and cheap, and so the money goes back into the same fund, if that's what you want to do.
Well, one thing I've never seen actually is I've never seen the figures run on basically the difference between reinvesting your dividends into exactly the same shares and just reinvesting them within your portfolio. And that would actually be a very interesting study to see, but I'm not sure whether anybody's done that.
And ignoring costs, I suspect reinvesting in the same share would do better than you might think. You might think that this dividend stock had got too pricey, but it might work out better than you might think. Yeah. That's my hunch.
I think the other thing you need to consider is actually the frequency of the dividend. Historically, you probably looked at every 6 months a big company would pay something. But there's a lot of companies out there now realise that they can make themselves more attractive to investors if they pay, say, every quarter. And with the changes with the pension rules, you're now getting monthly dividends. I mean, it's fascinating. They could almost sell themselves, but the danger is that people rush to buy those shares because they think, I'm going to get something every month that could pay my bills. But they're forgetting to look at what on earth the company does, or if the fund, what are the risks investing in. Actually, I think you're going to see a trend for more frequent dividends. So that particularly, you will have to think about costs if you're reinvesting, paying those charges every quarter or even every month. So. Okay, so do we have any more questions, please? Okay, just down in the middle here, please.
Probably sounds like a really basic and stupid question, but if a lot of these companies aren't raising new capital in the market, so why should they actually worry about cutting their dividends and their share price going down? What's their incentive?
Well,
they're not raising new money.
I guess that if you looked at it as a cynic, serious dent in the boss's pay packet, so he's not going to be able to buy that Porsche this year. A lot of bosses are rewarded in relationship to their share price, and so they don't like to watch their share price fall, and realistically shareholders don't like it and companies don't like it. You know, you could tell a company to think long term, but if a company's share price is down by 30%, they're not going to be feeling particularly happy.
And I've actually spoken to a couple of FTSE 100 CEOs who've complained to me that there's so much pressure, particularly from the income funds, for them not to cut their dividends. They think some businesses don't cut their dividend when really they should. But they know that the city will be so cross if they do cut the dividend that they don't dare do it.
Yeah, income fund managers are a bit like a group of bandits, you know, and they're holding these guys ransom, and you know, there is this sort of clientele effect. They're all like ganging up, and they're going, you know, you pay that dividend because I've got these. You've got a pension fund, they've got liabilities. They've got to pay off. You know, you've got to pay everyone who's retired who needs that income, and they want to pass it straight through. So it's really bad signalling to cut the dividend, because a huge part of the investor base is suddenly going to just drop the stock. And you know, there's a difference between sort of expected dividend cuts and unexpected dividend cuts. Unexpected dividend cut, you will see a huge drop in the share price. If it's expected, I think Glencore cut this week, and you know, it's already fallen a hell of a long way, so it's kind of expected. And you didn't see it fall on the day. So, you know, it's that signaling effect to the clientele that's so important, and why they don't like doing it.
And in extremis, we don't get this, but it doesn't really happen because executives give way, but in extremis, the shareholders can force the CEO out, can force the chairman out. And, you know, but you never get to that stage. They always give in.
Yeah. Okay, next question, please. Right at the back there.
I've got a question about making a decision to sell a line of stock, which you might well do if you thought that selling that and buying something better would be a good thing to do. If you have a stock and it's gone up in price and you think it's now overpriced and you want to sell it, then that's easy because you're making a gain. It's psychologically difficult to do it when a stock is plummeting. Does the panel have any advice about how to make yourself sell at a loss when it's sensible?
Just do it.
Yeah.
Honestly, there is a psychological trait. It's called loss aversion. It's called the disposition effect. We are inclined to hold on to hold on to our losers and sell our winners. We sell winners far too early, we hold losers far too long. If you actually looked at people's portfolios, and I do this on the website, and I look at the statistics, and you find that people in general hold their losers a lot longer than they hold their winners. You know, how many times do you hear that, you know, that phrase, run your winners, cut your losers, and nobody seems to do it in practice. And I go to events and I argue with value investors, and value investors will always say, oh, if the share price goes down, it's great because we can buy more of it. But actually, what happens if what happens if it is a value trap? What happens if you are in one of those sectors that is having a real long-term decline? You can find yourself, stuck and, as you said, holding something all the way down and then hoping it comes back. And you have all these psychological effects of, never wanting to sell a company once it's gone down because you've got what's called get-even-itis. You're like waiting to get even again. And of course, everyone else is waiting to get even again. So as soon as the market goes up a little bit, all those people who bought there are selling it. And it goes up here, those people are selling it. And it just, companies take a long time to come back, and there is an opportunity cost of keeping capital in shares that are behaving very, very poorly. Now, of course, if you're a very long-term investor, you might say, it's okay, I'll weather this out. It's still a very strong company. It's got a terrific balance sheet. And I think that's the one case where you would say, I'll wait. If it's got a very strong balance sheet, no gearing, it's not at risk, and you're sure, then perhaps hold it because it's still paying that dividend. But I'm a big believer in the power of momentum in the market. So I would rather be in companies that are growing dividends with rising share prices than I would in companies that are risk of cutting them and the share price falling. So in answer to your question, personally, I would say you've got to assess it. Check the quality and the balance sheet. If you're comfortable and it's long term and it's still yielding, hold it. If not, there are better opportunities out there.
It's wonderfully cathartic as well, actually. You know that bit where you open your portfolio and you see that horrible minus 30% in red? It's really great to open it and not see that anymore. Seriously, it is. It makes a wonderful difference. You open it every single day, every week, for a year, and you're going, oh, gosh, I should never have done that. You open it one day, it's not there anymore. You move on. I'm not joking.
Okay, have we got any more questions, please? Let's see. I can't see anyone. Oh, okay, just down here.
Surely the best way is to hold some short positions, is to work out your short positions, hold them, and when the market's down, they'll balance your portfolio.
Yeah, I've done that this year. I've been very, very. I've kept all my longs and had shorts.
We've been short on Glencore. We've been short on Tesco's. We've been short on Centrica. So it can help to, when you pick out a sector, like the mining sector, to look for some shorts. And if it goes down, those shorts will come in.
Of course, shorting has a lot of other. I find the easiest way to short is spread betting. It's probably the most. Any CFDs, and it's difficult for a lot of people to know what to short. I don't use shorting because I'm a pirate trying to sort of bring down Britain's finest companies. I do it because I like to. I personally this year I was nervous about the stock market and I wanted to hedge my long exposure. I didn't want to sell my stocks, so I wanted to hedge my market exposure. So shorting is quite an effective way of doing that. I was short Tesco too, so it's.
Well, I think especially now we've got Greece on the verge, that if Greece went bankrupt, properly bankrupt, you're looking at 1,000-point fall in the FTSE. You're looking at 1,000 points gone. Because Greece goes bankrupt, that's going to take quite a few Eurozone countries out with it. So you've got to hedge that there might be 1,000-point drop in the FTSE.
But I think it's very important to say that if you are not an experienced investor, I would not go into spread betting or CFDs, either without someone to properly show you attend a decent course, or someone who you had experience with a free money account. I think if you've invested for a long time, you kind of understand it. But please, that is an area. Go very careful.
And just to stress, say if you shorted Tesco now and the share price goes up 20%, Well, potentially, depending on how big your margin is, use the technical word, your loss as the share price goes up 20% can be a lot more than 20%. That is the big danger here. I've done some shorting in the past. It can work. It can be great. I'd also say it's pretty much a short-term game, and I do think for most people, investing should be for the long term. That is what works best. So you need to be quite confident and pretty experienced to try this out, and be aware that it can go very badly wrong.
Definitely, the spread betting companies actually make all their money because nobody understands the leverage. They basically figured out that most people, look, if you're going to do £1 a point on Imperial Tobacco, I think Barclay Group's at 20 quid at the moment, something like that. That's £20,000 worth of exposure on a £1 per point trade. Whereas if you look at something like, a small cap that's trading at £1, that's only, 100 pence, sorry. 100 pence is £100 of exposure. So depending on the share price, you can put what looks like the same bet on, but have wildly different exposure. And that's one of the reasons so many people blow up in spread betting, because they just don't understand the leverage.
And also, it's worth pointing out, with spread betting, if you make a profit, it's tax-free, which is fantastic. But I think many people think the reason why the Treasury doesn't tax spread betting profits is they know most people make a loss, and they don't want to create tax losses that people can use against other profits elsewhere. And that really is an issue there.
Yeah, and the thing about spread betting is that if you know what you're doing and you've got a system and you stick to it, then it can work very well. Same with CFDs. But most people don't have a system and they don't stick to it, and they don't do very well at all. And I know plenty of people who've done it and lost lots of money. And shorting is a good idea if you know exactly what you're doing. Unfortunately, the ways that we have at our disposal to short companies easily are also the quickest and easiest ways to lose lots of money. So don't forget that bit.
Yeah, I could say it definitely has a value, but be careful on your journey before you experience what's going on. So we've got 3 minutes left. Let's go straight back to our favourite topic of income rather than spread betting. And let's see, any more questions, please? Okay, gentleman down here. Okay, so if you didn't hear that, what's our views on income from the energy sector? Obviously, utility companies historically been seen as real favourites for income investors. Sort of 5-6% yields were not uncommon, but I guess things have changed slightly, haven't they? So any of the members of the panel?
Sometimes you've got to look at companies and sectors and ask whether things are going to change there and whether stuff is genuinely changing, they're being shaken up. Now, if you're looking at our household energy companies, then I would say things are definitely being shaken up. There's a big shift, people moving towards smaller suppliers and things like that. Still only a very small amount in the market, but that's where the momentum is. Look at the rest of the energy sector, the big gas and oil producers and things like that. They're very beaten up at the moment. Are they going to come back? I don't know. It's very difficult to say, and you look at those yields and you think, how sustainable are they? But I think Shell, isn't it, is one of those companies that's raised or maintained its dividend every year for an exceptionally long time. Is that correct?
Yeah, since Second World War, I think, or something.
Yeah. So you look at Shell and you think, are they really gonna ruin that? I don't know.
So we'll see. Yeah, I mean, there's a stock called Infinis, which is was trading on sort of 12%, which is like wind power. But if a government says pulls subsidies for certain areas of renewable energy, things like that, it could just really change the landscape.
Yeah, interesting enough, I've got a list here of 20 top 20 dividend yields above 3% according to our ranking system. There's not a single energy stock on it. So I was going to say something, but then I shut up when I looked at the list.
I mean, although I was saying half an hour ago, don't put all your money in one sector if you're an income investor, and I mean that, the one sector that, for me, is offering decent yields and looks attractive for other reasons is pharmaceuticals at the moment. So that's one way to go if you're looking for quality companies paying a decent yield.
Yeah, I think actually there's no pharma there, but just in case, if you're interested, I'll quickly, in our last 50 seconds, run off some of the names. So Indivior, which is, actually no, that's a spin-off of
Reckitt,
isn't it? So that's currently yield. This prospective or this
prospective,
is prospective yield.
Months, yeah.
So this is so where are we? We've got 3 and a bit %. So we've got Barclay, the house builder, Royal Mail, Headlam, Epwin, Persimmon, Games Workshop, and Reddy and RM. So a real good spread of sectors there.
Yeah.
But yeah, so
we're finding a lot of cyclicals in there actually, because we're still economically, it's still actually been going pretty well. Maybe not for Greece, but we're still in recovery. I was just speaking to the guy who built our stand outside yesterday, and he said he has never ever been busier in the conference space. So it does, while everyone gets nervous about the stock market, one should remember actually on the ground level things are cyclically have been doing quite well.
I mean, the house builders are a sector that are paying a lot of income at the moment because they've got a lot of cash. They're throwing off cash, and they've also got very strong balance sheets compared to where they were in 2008. So that's a sector that's worth looking at, but just bear in mind that at some point the housing market will sink again, because that always happens. House prices don't always go up.
Okay, that's all we got time for. Hopefully that was useful. Thanks ever so much for listening. Thanks to my panel.